Welcome back. You're watching The Money Show, and now it's time to answer your portfolio queries. I have with me Shweta Jain from Investography. Shweta, good evening and welcome to the show. And for all the viewers who are watching our show live and want to send across your queries, you can do that on our WhatsApp number and our email ID. And you can send across your questions on 865-797-4571 and themoneyshow@etnow.tv is our email ID. Shweta, let's begin. And I have Mr. Rama Desikan from Chennai who want to ask you his question. Good evening, sir. How are you doing today?
I'm doing fine, great. I regularly watch your money show. It's very good,
Thank
very
you so much, sir.
informative and educative too.
Thank you so much, sir. So, as per your question, you want to know if debt funds are better and safe and also give good interest payouts as compared to fixed deposit and also well rated in terms of ratings and fixed deposit and NBFC's fixed deposit. So, you want suggestions on debt mutual fund category. Is that right?
And are they really offering better than the highest interest yielding NBFCs and banks?
Sure.
Or debt funds? Are they just tax efficient?
Perfect. All right, let's get that answered. And I'm sure a lot of other investors who are into conservative investment or don't want to take much of a risk with their money would want to understand this also. So, Shweta, in terms of taxation, debt mutual funds, fixed deposits, bank fixed deposits, corporate fixed deposits, all are at par right now. Can we say that?
Yes, Kavita, they're absolutely at par. There's no difference in terms of taxation. In terms of returns and risk, there is a lot of difference, whether it's FD. So in debt, I actually like to see it that the money that we put it in debt mutual funds or debt as a category should be safe first, and then look for whatever a little bit of extra return, but provided it's safe and that's immediately accessible, or that it's not at any question, that there is any kind of risk, whether it's interest rate risk, whether it's credit risk. So FDs are obviously the safest. NBFCs and bonds from them, I'm not really sure how safe it is. Depending on the rating, depending on the companies, this may vary. Debt mutual funds are much safer than individual NBFCs. That I can say with kind of a surety, a certainty, because they are spreading their investments over a range of whatever the instruments that they are going to invest in, right? So if it's gilt, they're going to invest in a range of government securities. If it's corporate bond fund, they're going to invest in a range of companies in corporate bonds. So right from rated AAA to whatever is the mandate of the scheme, right? So I would recommend Mr. Ramadesikan to look at debt as a category, which is going to give them slightly higher return, provided the safety is there. So definitely keep it a combination between FDs and mutual funds, not look at NBFCs, because then they are not diversifying. Whatever, if it's say 1 lakh, you're investing in say an ICICI approved corporate bond fund, you're still investing in say 40 or 50 securities. In an NBFC bond, you're going to give it only to one entity or two entities. How many entities will you give and manage, right, individually? So that is the big risk. Taxation wise, they're absolutely the same. There is absolutely no difference. So you can put it in 3 different kind of funds is what I have recommended. Kotak Gilt, ICICI approved corporate bond fund, and Bandhan bond fund. So these are 3 very different kind of funds which will keep your money safe. But remember, mutual funds cannot guarantee neither the principal nor that they give you this amount of return. So that kind of risk you have to be okay with. If you're not okay, please stick to FDs. I would definitely not say look at individual bonds. Provided you're taking some risk, then that is okay.
All right, that's a solution for you, Mr. Ramadesikan. Thank you so much for sending us your question. Let's move on and let's take Saji Panakattil's question. And Shweta, he says that he's been working in Oman for last 20 years, current age is 55, and want to invest in SIP monthly mode for 5 years. And he's got some funds in his portfolio: JM Flexi Cap, Motilal Oswal Flexi Cap, Kotak Multi Cap, Nippon India Multi Cap. He's got ITI Mid Cap, Mahindra Manulife Mid Cap, Bandhan Core Equity, DSP Equity Opportunities, Bandhan Small Cap. He wants to know if the portfolio or the selected funds are good for him, and will he be able to achieve a corpus of 5 CR in 10 years with this kind of fund mix? Shweta.
So Kavita, this is an interesting one. I think he started investing last couple of years. So a lot of mid cap, lot of flexi cap. I don't see too much large cap in his portfolio too. For me, the core part of the portfolio is a little bit that's missing, I would say. Some of the schemes do have a bit of overlap, but I'm okay considering that he has a lakh rupees of SIP going. But to get to his goal, he would need to increase his SIP amount to 2 lakhs. The schemes are okay provided he's okay with the volatility. Otherwise, I would definitely recommend that he starts with a UTI Nifty 50 so that there is a core part of the portfolio building. He can stop a couple of the flexi caps, JM Flexi Cap, Motilal Oswal Flexi Cap are schemes that he can stop.
All right, let's move on. Let's take Balaji Venkatai question from Chennai, and he says that he is 53 years old and looking to accumulate retirement corpus of 3 CR in next 7 years, and current portfolio has Mira Asset Mid Cap. He's got 10 lakhs in it, Parag Parikh Flexi Cap 11 lakhs, Quant Flexi Cap 10 lakhs, Quant Small Cap 10 lakhs, UTI Liquid 2 lakhs, and total investment amount is 43 lakhs. He also have 25 lakhs in savings account, which I think he wants to invest, and he wants to achieve a corpus of 3 crores, and he wants to know if the fund mix is good for him or not, or any other fund that you might want to recommend where he can invest his 25 lakhs. And yeah, that's all. Shweta.
Yeah, Kavita, it's an interesting portfolio. I would not add to these schemes at the moment. Quant, definitely not. Keep it as a scheme that you don't withdraw, but you don't add on as well. UTI Liquid is something that he needs to see why he has it in the portfolio. If it's for an emergency fund, then that's okay. Otherwise, he can switch that to a UTI Nifty 50 fund. For the additional 25 lakhs, I would recommend ICICI Large and Mid Cap, Kotak Emerging Equity, and UTI Nifty 50. 10, 5, and 10. What he can do is with this portfolio, he will get to 1.5 crores. If he wants to get to his corpus of 3 crores plus, he will need to do additional 2 lakhs because the time horizon is quite short. I would definitely urge him to increase his time horizon in equity. So while he can invest for the next 7 years, he can stay invested furthermore, and that will help him compound his wealth and make sure that post retirement also his money is growing, and at the time of retirement, maybe 2 to 3 years before retirement, he can start looking at revamping the portfolio, look at how much he wants in debt, how much cash flow he needs, and how much he would like for growth.
Okay, next question is from Mr. Gopal Krishnan, and he says he's 50 years old and is doing an SIP of 30,000. He wants to build a corpus of 1 CR by 2030, and he wants you to suggest him a few funds for this particular investment.
Yeah, so for 6 years, I think if he wants to do an SIP of 30,000, he will need to do an SIP of a lakh a month to get to his goal, not just 30K. That is something that he will definitely need to change. 6 years is quite short period for compounding to take effect. It's in the initial stages, I would say. Although now he can start with funds like UTI Nifty 50, Kotak Emerging Equity, ICICI Large and Mid Cap. But like I've told earlier as well, at retirement, your money doesn't have to stop working for you. In fact, it should work harder. So even when he retires, he can have more in equity depending on how much cash flow he would need.
All right, on that note, it's time up on the show today. Thank you so much, Shweta, for being on the show and helping our viewers with their financial portfolio queries. And I'm going to leave our viewers with our WhatsApp number and email ID. Just in case you are watching our show and want to send across your questions live, you can do that. 865-797-4571 is the WhatsApp number, and the moneyshow@etnow.tv is the email ID. So do send us your queries and we will get it solved by our experts live on the show. Thank you so much for watching. Goodbye.
If you like this video, then like, share and subscribe to ET Now.